Tesla just filed to bring the Model Y performance back to China after an 18-month absence, quietly adding its higher-priced, higher-margin version to exactly the market where its sales have been slipping. We've also got a bold new case for full self-driving from a Wall Street analyst, Tesla tearing down the original line that built the Model S and X to make room for Optimus, a big energy milestone in Australia, and more. This is the Tesla Brief, after the close on July 10th. Welcome to the show. A quick look at the stock. Tesla closed up 0.7% at $407.76, while the Nasdaq added about 0.3 and the S&P 500 0.4. So Tesla edged out a broadly green market on a fairly quiet day, a modest move with no single piece of company news behind it. Let's start with China. Tesla has filed a Model Y performance variant with China's industry ministry, and it showed up in the regulator's catalog that was published today. It's the Shanghai-built car, with dual motors, 176 kilowatts up front and 291 at the rear, and a top speed of 250 kilometers an hour. That's well above the roughly 200 cap on the rest of Tesla's current China lineup. So this is clearly the fast halo version of the car. Here's the backstory. Tesla actually dropped the performance trim in China in early 2025 when the redesigned Model Y, the one nicknamed Juniper, launched. But it's since brought that trim back everywhere else: Europe, North America, Australia. China was the one market left without it. So this filing closes that gap. Now, why does a single trim matter more than usual here? Because of where Tesla's China business sits right now. China deliveries fell about 2% year-on-year in the second quarter, the fifth quarter in a row of declines. And China just slipped below 30% of Tesla's global deliveries for the first time since late 2020. So this is a market under real competitive pressure. Read constructively, that's exactly why the timing is interesting. When you want to lift demand across a whole lineup, one classic move is to add the halo version at the top, the fast one, the desirable one. It raises the appeal of the entire range, not just the trim itself. And it's a higher-priced, higher-margin car, so it helps the mix too. It also lands the same week the standard Model Y was, once again, China's best-selling passenger vehicle of any fuel type, and it did that while carrying a higher price than everything else in the top 10. That's genuine pricing power holding up in the toughest EV market on Earth. The near-term read on whether that pricing power is holding comes Monday. That's the figure to watch, to see if the demand story is turning. That demand question runs straight into the next story, because there's a growing argument on Wall Street that the thing which actually resets Tesla's demand isn't a new trim at all. It's full self-driving. Pierre Ferragu, a long-standing Tesla analyst at New Street Research, laid out a genuinely striking version of that case today. His core claim: the vast majority of the market has no idea what FSD can actually do and only discovers it gradually. And his headline line was this: a Tesla is not a car the same way an iPhone was not a phone. That analogy is worth unpacking because it's the heart of his argument. When the iPhone launched, people estimated the market at around 10 million units because they were pricing it as a phone. Then buyers realized it was far more than a phone, and today something like 250 million sell a year. Ferragu's point is that a Model 3, call it $35,000 plus $100 a month for FSD, looks expensive if you think of it as a car. But it looks cheap if you think of it as a tool that drives you to work while you do something else. And his argument is that the market simply hasn't repriced Tesla for that shift yet. His evidence isn't just vibes either. He points out that the number of people newly turning FSD on ran ahead of Tesla's US deliveries in the first quarter, meaning more people are switching FSD on than Tesla is even selling new cars in that market. Pair that with the big beat on second quarter deliveries, and he reads it as the early signs of an inflection point. He's asked for 2 more quarters to see where it's heading. And there's fresh evidence for exactly that funnel today. Tesla began rolling out FSD version 14, the trimmed-down Lite build, outside the United States for the first time, with early access landing for owners in South Korea. Crucially, it's reaching cars on the older Hardware 3 computer, not just the newest hardware. There's a broader push to US-built Model 3 and Model Y cars still on that older chip too. Why does that matter? Because the size of the FSD-capable fleet is the raw input to Tesla's whole autonomy revenue story. Every older car that can run version 14 is a car that could become a paying FSD subscriber, or feed training data back to the system. The honest caveat: the Lite build on Hardware 3 is a stripped-back version, not the full experience the newest cars get. But widening the pool of cars that can even try it is exactly the kind of thing that feeds Ferragu's discovery mechanism. One more piece fits the same logic. Job postings show Tesla is expanding its own vehicle rental program to 4 more states: Maryland, Kansas, Washington, and Pennsylvania. These rentals come with unlimited miles, free supercharging, and FSD switched on, typically over 3 to 7 day windows, at $60 a day for a Model 3 or Y, and $75 for a Cybertruck. There's no confirmed launch date yet. The evidence is the hiring, not an announcement. But think about what a rental actually does here. It's a low-commitment way to put someone behind the wheel of a Tesla, with FSD running for several days at a stretch. If Ferragu is right that people don't understand FSD until they experience it, that's precisely the kind of funnel that turns a skeptic into a buyer or a subscriber. Small operationally, but it's the same demand generation thread running through the whole day. Now to Optimus, where Tesla put out something genuinely symbolic today. It released video of workers tearing down the original Model S and Model X assembly line at Fremont. The line that built the cars that frankly saved the company and made it what it is. That line is coming out to clear space for Optimus robot production. 2 numbers stand out. Tesla says the decommissioning took just 46 days, under 7 weeks. And it says that once fully ramped, that space will be able to produce 1 million Optimus robots a year. This advances a story that first surfaced in late June, when word was the line was being converted. Now Tesla is publishing footage of the old line physically coming out. And it lands the same week drone shots showed the scale of a separate, purpose-built Optimus factory going up at Giga Texas. One thing to keep in proportion though, that 1 million a year figure is a stated capacity ceiling, not current output. Optimus version 3 is still targeted to start production in late summer, with no firm public reveal date yet. So what we're watching is capacity being built ahead of a product that hasn't shipped at volume. That's the normal Tesla pattern. Build the factory first, fill it later. But it's worth saying plainly, so a capacity headline doesn't get mistaken for robots rolling off the line today. On the energy side, Tesla's Megapack team says 10 gigawatt hours of its industrial storage products are now operating across Australia. In their words, that's equivalent to 160,000 Model Ys of battery capacity. And they added, they're just getting started. That's a meaningful step up from where the Australian number sat a week ago, and it's around verified figures straight from Tesla's own energy account. The energy business rarely leads a day, but it's quietly been the most consistent record setter in Tesla's numbers this year. And each of these deployment milestones is a small proof point that the Megapack backlog is converting into operating, revenue-generating capacity, not just signed contracts sitting on paper. A few quicker items to round things out. Elon sat down for an exclusive on-camera interview with CNBC's Julia Boorstin around midday, a rare live sit-down from Tesla's CEO on a top-tier business network. We can confirm the interview happened. The specific Tesla substance he delivered is still being pulled from the segment, so we're not going to put words in his mouth here. We'll cover what he actually said once it's properly sourced. Elon did spend most of his morning, though, on XAI rather than Tesla, amplifying results for the new Grok 4.5 model. The one worth flagging, an independent leaderboard put Grok 4.5 first on an agent automation test, completing just under 80% of task objectives. That's ahead of the top models from Anthropic and OpenAI, and at roughly a third of the cost per task. The Tesla connection is the shared XAI relationship. Tesla's engineers use Grok, and Grok voice control is coming to FSD. A frontier model that's both best-in-class and much cheaper to run strengthens the argument that Tesla sits inside a real AI ecosystem. The honest note, this is XAI's win, not Tesla's, so keep it in that lane. Staying in AI, Apple has sued OpenAI, alleging former Apple employees who moved to OpenAI took confidential information about unreleased Apple hardware to help build OpenAI's own consumer device. Apple wants a jury trial and a redesign of that upcoming hardware. For a Tesla audience, this is indirect. OpenAI is the flagship rival in the Elon versus Sam Altman AI contest, so any legal cloud slowing OpenAI's hardware plans nudges the competitive map that XAI and Tesla both operate in. It's worth logging, not a thesis mover. And in the community, the day's fixation was fresh drone footage of Cybercabs stacking up in the outbound lot at Giga Texas, alongside a viral claim that the Cybercab could become one of the most aerodynamic production vehicles ever built. Here's the context worth adding. A low drag number is real engineering, but for a robotaxi, it isn't the metric that moves the thesis. What matters is cost per mile and how many cars are actually running paid rides. The useful signal in those shots is simply that production vehicles keep accumulating, but the paid in-service fleet has stayed flat at around 20 cars, even as the service area is expanded. So watch the count of cars carrying passengers, not the count parked in the lot. Which brings us to what's on the calendar. The one dated catalyst that matters most in the near term is Tuesday's U.S. inflation report, and it matters because of where the Fed now sits. The June meeting minutes confirmed the Fed has flipped from leaning toward cutting rates to leaning toward raising them, with most officials now expecting no cuts at all this year. For a fast-growing stock like Tesla, that backdrop cuts both ways. A hot inflation number hardens the case for higher for longer rates and tends to pressure fast-growing companies, while a soft one gives them room to run. A producer price reading follows Wednesday as confirmation, and that's really the setup for the bigger event 3 weeks out, Tesla's second quarter earnings, expected late July. Gene Munster at Deepwater flagged that there are 9 trading days until tech earnings kick off with Tesla and Google, and said he expects measurable upside that should be favorable for the broader AI trade. So the question hanging over the next few days is simple. Does Tuesday's inflation print harden the Fed's hawkish tilt, or does it give growth stocks like Tesla some room? Tuesday's the macro backdrop. Late July is when Tesla's own numbers land into it. That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.